Here's the most common scenario. You see a trade setup, you decide it's a good one, and you pull the trigger. Then you place the stop loss, set the take profit, and that's it. Sometimes it hits your stop. Sometimes price goes right to your target. But what about those times when price almost hits your level? Do you know how to protect your trade? What if it returns to your entry? Do you know what to do? What if it hits your stop loss in the first place and then starts to go in your initial direction? And what if your take profit is too low and you're settling with a small gain? Taking profit is one of the most critical aspects of a successful trading strategy. You want to minimize your risk and maximize your profits. Today we'll talk about this. So, like, subscribe, and stick around for the full video. Setting single profit targets can seem like a simple and straightforward strategy, but it comes with several disadvantages that you should be aware of. First, consider the missed opportunities. By setting a single profit target, you may miss out on potential profits as the market moves in your favor. For example, if you set a profit target at the price of $100 and it continues to rise after hitting that target, you would miss out on the additional gains. Rigidity and lack of flexibility is another disadvantage. Single profit targets can limit your ability to adapt to market changes. If the market almost hits your target, then moves in the other direction, you may be unable to take advantage of new opportunities or adjust your strategy accordingly. Not to mention the psychological burden. You may feel the pressure to reach that target and may be more likely to make impulsive decisions. It's important to be aware of the disadvantages of setting single profit targets and consider alternative approaches. A better strategy is to scale out of positions and have multiple profit targets. Scaling out of positions refers to closing partial positions at different levels of profit, rather than holding on to the entire position until the target is hit. Let's say you buy a stock at $20 and set a target profit of $30. Instead of holding on to the stock until it reaches this price, you may choose to sell half of your position at the price of $25 and the remaining half at $30. This strategy has several benefits. First, it reduces the risk of giving back all of the profits if the market suddenly moves against you. By selling partial profits at different levels of profit, you will reduce your exposure to the market. Second, scaling out of positions allows you to manage your emotions and avoid becoming too attached to a trade. Holding on to a position for too long can create anxiety and fear, especially if the market moves against you when you've already been in profit. By selling partial positions, you can reduce the emotional impact of a trade and make more rational decisions. You can also leave a portion of the trade open even after your final target is reached. You bought at $50 and set two profit targets at $55 and $60. You can sell 25% of your trade at the first target, 50% at the second and final target, locking in profit and reducing your exposure, and you let the remaining size opened. Who knows, maybe the market will move to $70, $80. This way, you have a chance to capture a much bigger move. A trailing stop can be a powerful tool to ensure that you maximize your profits while minimizing your risks. Suppose you bought a stock at $100 and set a trailing stop at $10. If the price rises to $110, your stop loss will adjust to break even at $100. If the price continues to rise to $120, your stop loss will continue to move up, always remaining $10 below the current price. The most obvious benefit of using a trailing stop is that it allows you to maximize your profits. By continuously adjusting your stop loss as the price moves in your favor, you can lock in profits while avoiding premature exits. This can be especially useful when the market is trending in your direction. Another benefit of using a trailing stop is that it helps you minimize your risk. As the price moves in your favor, your stop loss moves with it, ensuring that you are protected in case the market turns against you. This way, you can avoid losing money on a trade that was in profit. A trailing stop is a dynamic exit point that changes as the price changes. This allows you to stay in a trade for as long as possible while still protecting your profits. You can choose a trailing stop based on a percentage of the price or a set number of pips, depending on your personal preferences. Here's a common mistake. You see a trade opportunity, you enter, and you set a money target of $100. When you see that you are up $100, you exit, even though the price may have further room to develop. While the idea of having a specific amount of profit in mind can be motivating, it can also be an obstacle to your trading account growth. There are several disadvantages when you set money targets. First, a money target can cause you to make irrational decisions. When you are so focused on reaching a specific monetary goal, you will make impulsive trades or holding losing positions longer than they should, which can lead to bigger losses. Second, money targets are not always realistic. You may set an overly optimistic target, which can lead to disappointment and frustration when the target is not met. And on the other hand, setting a target that is too conservative can result in missed opportunities for profits. So instead, you should focus on developing a comprehensive trading strategy that takes into account market conditions, volatility, and other price action factors. Scaling out of positions at previous swing highs or lows is probably the simplest strategy if you are looking to manage risk and maximize profits. Basically, you take partial profits and minimize the impact of potential market reversals. Let's say you have a short position in a downtrend. If price reaches a new swing low, you take some profits off the table and reduce your exposure. At the same time, you can move your stop to break even. This can provide a safety cushion in the event of a market downturn. You can use the swing high or low points to reevaluate your trading plan and make any necessary adjustments. For example, if price reaches a swing low but then fails to break out to new lows, this may indicate a change in market sentiment, and you may want to consider exiting your position altogether or adjust your stop loss levels even closer to the current price. Taking profits at supply and demand areas is another strategy. The main idea behind this approach is to take advantage of the natural forces of supply and demand that drive the price movement of a market. For example, you bought at this demand level, and price has risen to a significant level of supply. Here you may choose to sell a part of your position. This way, even if the price does eventually fall, you will have already captured some gains and protected your capital. Another benefit of scaling out of positions at supply and demand areas is that it can increase the efficiency of your account balance. By closing partial positions at key levels, you can free up capital that can then be used to enter new positions. Taking profits using average true range or the average daily range is another strategy. This technique involves monitoring the market's volatility as measured by the average true range and using it to determine the best time to take profits. Knowing the average daily range is extremely useful since it allows you to estimate how much profit potential there is in the market. For example, if you are a forex day trader, there is no point looking for 100 pips of profit from a trade if the average daily range for that currency pair is only 60 pips. The average true range can be used in combination with other take-profit strategies to improve the accuracy of trade timing. For example, you may choose to take partial profits when the ATR crosses above a certain level and price reaches a major support or resistance level, or an area of supply or demand. Taking profits using Fibonacci extensions is my favorite take-profit method. Fibonacci extensions can be used to project potential levels of price action beyond a retracement. In short, you get clear and objective exit points. For example, if you buy a market in an uptrend, you can use Fibonacci extensions to find potential levels of resistance where you can scale out of your position. If the price reaches the 100% extension level, you may choose to sell a part of your position. If price continues to move higher, you may choose to sell more of your position at the 161 extension level and maybe move your stop higher. By using these clear and objective exit points, you avoid overstaying in a trade. Using VWAP bands or Bollinger Bands is another alternative to scale out your positions. The idea is simple. You will use these bands to identify dynamic support and resistance levels. If price is approaching the upper VWAP band, it may be a good time to scale out of a long position and take profits. This is because the price is likely to experience some resistance at the upper band, which may cause it to retrace. Similarly, if price is approaching a lower Bollinger Band, it may be a good time to take profits on a short trade. This is because the price is likely to experience some support at the lower band, which may cause it to bounce back up. Taking profits using pivot points is another reliable method. Rather than relying on subjective interpretations of price action, pivot points offer a systematic approach you can use to make decisions. This can help you to avoid the biases and emotions that can often lead to poor decision making. For example, if price reaches a resistance level marked by a pivot point, you may choose to take some profits at that level in anticipation of a potential price decline. The end of the day or the end of the week can be an ideal time to scale out of positions because it allows you to take a step back and evaluate your positions in the context of wider market conditions. If you are a day trader and your trade is in profit at the end of the session, you might want to limit your risk. You don't know how the market will react at the open of the next session. The same if you're a swing trader and you have a decent profit on your trade. Before Friday's end of the session, you may want to reduce your overall risk. You've seen those big weekend gaps, so take some profits off the table and move your stop to break even. Taking profits in a trending market versus a ranging market requires different approaches, as the market dynamics and price movements can be vastly different. In a trending market, price moves in a sustained direction, whereas in a ranging market, prices oscillate within a certain range. In a trending market, you can look to take profits at key levels of resistance or at Fibonacci extension levels, where the trend's strength appears to decrease. On the other hand, taking profits in a ranging market can be more challenging, making it difficult to determine when to take profits. Pivots are good targets when a market is stuck in a range. VWAP bands or Bollinger Bands are also very useful during these conditions. You need to understand the market conditions and use the appropriate tools and techniques to determine when to take profits. Now, your take profit will never be hit if your stop loss is constantly being hunted by market makers and smart money. If you want to learn how to avoid stop-loss hunting and avoid market manipulation, you must watch this video. And check out our Academy program if you want to further level up your trading. Until next time.